I'm back today with another video, and today I'm going to be going over the importance of big figure levels and what they play a part in when I'm trading in the market. So the importance of these big figure levels is not nothing crazy, but you wouldn't expect as many people to not understand this as you would think. So let's just go over the basics. So what are the big figure levels? Some people might go off of quarter points. I personally used to go over quarter points, but the big figure levels I use as of right now are all of my 000 levels, all of my 200, 500, and 800 levels. An example of these would be 34,000, 34,200, 35,500, 36,800, 38,000, 39,200, 39,500, 39,800. So those are the examples of the big figure levels I have. And as you can see, those levels are all marked up with these black lines. So all of these levels, the 000, the 200, 500, the 800 levels, these big figure levels are delineated with the black line. So this right here, this line, this line, this line, this line, this line, all the black ones are those big figure levels. The small figure levels are going to be every 50 points in between. So an example of that, instead of 34,000, it will be 34,050, 34,100, 34,150, 34,200. So every 50 points in between these levels here. So the major levels you're going to want to pay attention to are the big figure levels. You don't even have to have the every 50, but personally I have them for my intraday trading, because you're not always going to be trading at a big figure level. Because if you look, we're on the 4-hour time frame. So in between all of these levels, so from 35,000 to 35,200, this is 200 points. This is 200 pips away. So you're not always going to be trading in these general areas. So a way that you could potentially look for moves intraday when you're day trading, such as I do, is you can use the every 50 in between these big figure levels. So now let's go over the importance of these big figure levels. Why are they important? These levels are important because these are the levels that the banks are trading off of. These are the levels that major, with people with a lot of money, they are trading off of these levels. These are the levels that a lot of orders are going into. And why is that important? Because if you can map out trades in these areas, you have a high likelihood of having a winning trade. It's not going to mean you're going to have a winning trade, but there is a high probability that if you get into a trade at around 800 or 500 level, there's going to be a reaction. Even if it's not a long-term reaction, you're more than likely going to catch some sort of move. And you can see that by going back in these charts right now, like I'm about to show you. So first, I'm going to show you these big figure levels and big figure reactions that they have. So you can see up here, look at this. Here, I'm going to pull this out. Look at 1, 2, 3. We had this area 35,000, which is right here. This is 35,000 level, traded into 3 times. Why did it trade in this level 3 times? Because this is creating orders in the market to push the market where it wants to go. When the market has consolidations like this, this is just creating liquidity to have a major move. And you can see that it happened right here. This move from this high was about 700 pips. If you go to the very low, about 740. And you can see that this range, the range was only about 200 pips from this 35,000 level to this 34,800 level. And you can see how perfectly it was trading off of these levels. It came from, look at this. I'm gonna go back in time for you real quick, so you can see. I'm gonna get rid of these lines. Just pay attention to what's happening. Price traded into 35,000, immediately started losing momentum and had a doji candle. What happened after? Price traded all the way down, came down to 34,950. Then what happened from here? Price traded even lower, came lower, had a little reaction, traded all the way down into this 34,800 level. And you can see the reaction it had from this level. We didn't have a reaction like that from these small 50 point levels. This is about a 50 pip rejection off of this area right here. So if you, just by yourself, if you would have been looking for potential trade off of this level, if you would have been looking on the lower time frame, say you had a stop, I'm just going off of higher time frame. So say you had like a 20 pip, 30 pip stop. If you would have held this trade and tried to hold it all the way up to this other 34,850, you could have had a potential 1 to 2 trade almost. This isn't perfect, mind you. This is hindsight. I'm just trying to show you examples. So what happened after this? Price then traded all the way higher, came back to 35,000. And now say you held that trade that you got in down here just looking for a potential 50 pips. Maybe you took profit, maybe you left it run. But if you would have let it run, that could have been a potential 1 to 4 trade based off of just going off of this 34,800 level and expecting a reaction. Even if this full move would have never happened, if you would have been able to hold this trade to this level or even this level, that would have been a 1 to 2 or maybe even a 1 to 3 trade. And if you held it even longer, going to this very high up here, this could have been a potential almost 1 to 5 trade based off of just going off of the fact that we traded into a 34,800 level, which is a big figure level where there's a lot of orders and a lot of traders, a lot of trades going into the market, and you can see the reaction I had. And mind you, this is not something that happens every single day. It's going to happen here and there. You're not going to get a trade that trades in between these big figure levels every single day. Some days you're going to be inside days, some days you're going to be consolidation days, and some days you're just not going to have as much movement. But you can see, now let's just go to an example down here. Here's an example of price not holding that level. So for example, this 33,800 level was not respected. It was respected one time right here, had a little reaction, but from here traded up to 33,850, and then from there had another push downside and then had a reaction up. This is an example of a trade you could have potentially lost just of going off of just this confirmation right here. That's why I stress to you guys, you have to have multiple confirmations. If you're entering a trade off of one confirmation, you should at least expect to have a 50-50 chance of winning that trade. But if you have 2 confirmations, that might have you a 60% chance of winning that trade. If you have 3, there's about a 70% chance of winning that trade. And if you have 4, there's about an 80% chance of you winning that trade. Why? Because the more reasons you have for why price should go into a certain area, the more likely it is to happen. If you have one confirmation, the likelihood of that one confirmation holding up is not going to be as probable as if you have multiple confirmations for why price should move. I'm going to show you another example of price reacting at a whole number big figure level. Another example I see is right here. You can see price had this reaction, traded from here, fell down, traded back up to this, what level is this? 34,800. We then had a strong wick. One thing you guys got to keep in mind too is don't look at the wicks. You can look at the wicks, but the main thing that is important is looking at the body of the candle. So if I take off my wicks, you can see how perfectly price reacts in these areas. If you're not looking at the wicks, you can see price traded up into this 34,800 level, consolidate a little bit before trading lower. Price traded straight into this area before trading lower. And if you look down here, you can see the reaction we had. Mind you, you're not going to be looking at wicks. If you're looking at wicks, you're going to see a lot of stuff. But the bodies of the candle is where majority of the volume is. And you can see price stayed holding that level before then decide to trade lower. So you can see the reactions I had. So from here, say you just would have been going off of this confirmation by itself. Maybe you had a fib drawn from this high to this low. And then from there, you saw that price was reacting at your fib level. Also, I had this here. So then you was like, okay, maybe there's a high likelihood price could have a retracement. Okay. Then you have your stop maybe right above this level right here. Looking to target this next area down here. This could have been a potential 1 to 6 trade based off of just 2 confirmations. I don't like to go off of just 2, but this is just, like I said, an example. And my last example right here is going to be up here. You can see right at this 35,000 level, price traded into it. Mind you, like I said, if you're not looking at the wicks, look at the bodies of the candle. Because if I take the wick off, you can see price traded close to this 35,000 level, then had an immediate push to the downside. So like I said, now say you wanted to get into a trade up here, could have had your stop. Okay, this shit's fucking me up right here. Let me take it off. Say you had your stop above this level, 60 pip stop, targeting the next level all the way down here, which is 34,800. Potential 1 to 3 trade, and then price trade even lower with a potential 1 to 8. But you're not always going to be catching these full moves, and you don't need to. You don't need to catch these full moves. So now that you understand these big figure levels, I'm going to be going over these intraday levels, which are every 50. So we're going to go into the lower time frame to show you guys that. So now that you understand that, you got to understand you're not always going to trade right off of these levels. You're not always going to trade directly to them. You're not going to have immediate reactions. You're not always going to be in there. So for example, I trade New York session. So during here is when it was New York session. This is all New York session up here. And in this case, price was at this 34,000 level, had a drop, traded into this 33,800 level. Mind you, this is at 10:15, 10:30. So this is a case where when you're trading and it is at this level, but we got to look for an example of, say I'm looking for a trade in the morning, I'm not near one of these levels. An example of that would be right here. So it's here, 9:30, this is New York Stock Exchange open. We were not at a big figure level. In this case, we were around 33, 34, 350. And then we came even lower to 33, 300. So this is an example of price not being at a big figure level, but still having that reaction to the top side, trading to 34, 500. I'm trying to look for a cleaner example because this one right here, you wouldn't have been able to get a good trade. You could have potentially pulled your fib from this low to this high and got in off of that. So you see, you pulled your fib from this low to the high of the current range that price was in, and you waited for that retracement. Then what happened? You waited for the retracement into this area. And in this case, this 34, 350 area happened to be at 70.50%. So then you had your stop right below here, 50 pips, looking to target this whole number at 35,000, 34,500. This is a potential 1 to 2 trade, almost a 1 to 3. And if you held a little bit longer, going to the next 34,550, a 1 to 3 trade. You see, going off of strictly just off of these levels, because when you're not at these big figure levels and you're looking for trades, you can still anticipate a reaction from these levels. Why? Because these are still institutional levels where there is a lot of orders getting put in. Another example all the way up here, this is an example of during London session. And during London session, you can always anticipate some sort of false breaks or making the high and low of the day, so you can anticipate some sort of retracement or reversals. In this case, you can see price cleared these highs right here at 245, immediately traded lower, traded higher again, and say right here around 5 a.m. say you got in at this 34,650 level. Why? Because say you pulled your fib from this high right here to this low, you saw that price traded into your optimal trade entry at 70.50% and 62% at this 34,650 level, and you're like, okay, that's enough confirmation for you. Me personally, that wouldn't have been enough for me. Had your stop above this high, because you already saw that price cleared the liquidity, so you wouldn't want to see price trade to it again. Where would you look to possibly target? Possibly target 34,500. And in this case, price does go here, and straight from this is a 1 to 4 trade, trading off of this 34,650 level. It's not a big figure, it's not an 800 level, it's not a 000 level, it's not a 500 level. It's in between, it's every 50, and you can see the reaction it has. And if you go even lower onto these lower time frames, you can see the reactions are even better, because you can get even more precise entries. You can see price respects these levels key. You can see how well they respect these levels. These aren't just random levels. You can see how well they respect it, use it as support, resistance, respect, consolidate in these levels, have reactions, they target these areas. And you can see how well you could potentially look for trades off of these levels. But like I said, this isn't a strategy. This is just an extra confirmation and another thing to always keep in mind. So say I have 4 confirmations, not even looking at where price is. And then I look at where price is, and then I can be like, okay, say I was looking to go short right here. This is just a random example. This is where the market is as of right now. Say I see this price is reacting, trade it close to this 34,500 level, right? And now we're starting to reject. Say now I want to look for a potential sell, keeping my stop above this level at 34,500, looking to potentially target this level down here at, what is this? This is 34,000. And why am I targeting this area and not this area? Because for one, you could potentially look at to take profits off here, which would be a 1 to 1, but down here is a 1 to 2 trade. So this is what you would be looking for basically, this is a good trade setup. You don't want to be taking 1-to-1 trades, because if you lose one trade and win one trade, you're going to be break even. But if you have a 1-to-2 trade, you could lose a trade and you'll still be in profit. So say you target this area because it's a 1-to-2 and there's other confirmations such as this 1 hour order block. You also have this 2 hour breaker block right here. So you have other reasons to target this area. And now say price does go to your TP. You're not going off of strictly based off of these levels, but you had other confirmations to then help you with having more reasoning to trust that trade. So yeah, that's really it. Just one tip I give you guys is just always pay attention to where price is at the moment before you take a trade. If you notice you're at a whole number level or a big figure level such as 35,000 or 34,500, you can anticipate a reaction from that level. And if you put time and price together, say you're trading at 34,500 at around 9:30, the New York Stock Exchange open, there is a high probability that you're going to get a reaction at that time. Even if it's not a 1,000 pip move, you don't need to be catching a 1,000 pips move. Just a 50 pip move is all you need. Just a 100 pip move is all you need. You don't need to be chasing these big moves. You just got to catch a portion of this move, and it's going to make you your money that you want to see. And you can see with these trades, you're getting about 1-to-2, 1-to-3 trades, 3 times your risk almost every day. And that's strictly just catching a little bit of the move, not the full move. So yeah, that's really it. This is a simple video. I just wanted to go over just in case for the ones that don't understand why these levels are so important and why I use them. You can see it yourself. You can see the reactions price has in these levels. Reacted perfectly, traded down. Reacted perfectly, traded down. Reacted perfectly, traded down. Came up, reacted, came up for the last reaction, traded down. Price came up right here, had a trade down. And you can see when price has these moves, it's more than likely always rejecting one of these levels. It's not having a wick in between, such as like this, going halfway before falling. It more than likely always touches the level before going the opposite direction. And you're not always going to win these trades, just keep that in mind. But with experience and looking at it every day, they're only going to get better. So hopefully this video was helpful. Hopefully I taught you something you didn't know, and hopefully this helps you going into the next trading week this week. So if you liked this video, if I helped you, make sure you like, comment, subscribe, and I'll see you guys in the next video.